Today, I want to talk about houses in Canada. So, if you're somebody who's looking to know more about what kind of houses we see in Canada, what kind of prices are there, what's the down payment and mortgage requirement, what is mortgage insurance, then this video is for you. I have divided this video into four parts. So, if you don't like any of the parts that you don't want to see now, you can skip that part and move to the next part. The first part talks about the types of houses. The second part talks about the average house price in Toronto right now. The third part talks about down payment and mortgage requirement. The fourth part talks about the mortgage insurance. Now, starting with the first part, the types of houses. So, in Canada, there are primarily four categories of houses. One is detached house, the second is semi-detached, the third is townhouses, and the fourth is condominium. So, I'm first going to talk about the detached house. Detached house is the one which is a standalone house. So, the boundary wall of that particular detached house doesn't touch with boundary wall of any other house, any other property. So it's a single standalone unit. So you get more area, more privacy. The detached house generally has a basement also included in the house. So that's additional area space you can use for your own personal purposes, or you can give it on rent to somebody and you can say you can let it out and earn some money on that. The second one is semi-detached house. So semi-detached house are basically two houses joined together. So they look completely identical. They are built in pairs, so it's going to be one house touching the wall of the other house. So if you see from a wide angle, you will see that it looks like a one single house, but there are actually two houses, one on the left and one on the right. Third is townhouses. So townhouses are multiple houses built together. They look completely identical. It's just that they are built in a row. So there are probably 8, 10, 12 houses joining one another. They are built in a row. They are clubbed together. So that complete development is known as townhouse. The houses look completely identical. So with the townhouses also, you own the land and you own every bit of interior that is there in the townhouse. Now the fourth one is condominium. Condominium is just like an apartment building that we see in other parts of the world. There is a unit that you buy. You have complete right on that unit. Anything on the interior is going to be completely yours. You can do whatever you want to. And all the common areas are commonly owned by the other owners of the units that are there in that particular building. Typically, to manage that condominium, there is a condominium association who's going to take care of the expenses. Now, coming to the second part, which is about the prices in Toronto right now, or in GTA, I would say. So, GTA is Greater Toronto Area. So, if you're thinking that due to Corona or COVID, the prices are lower, it's not the case. Prices fell, sales of units, it fell in the month of March and April, but since May, it has been recouping, so it has gained momentum again. And imagine in July last month, as per the latest data of GTA, Greater Toronto Area, the average selling price of a house is $950,000. So just imagine it's an expensive house. Prices are going up. There is a lot of traction. People are buying houses. They are not stopping. Now, when we come to a situation, what is happening at the ground level? So for one single house, which is there in the market to be sold in the MLS system is the listing system where all the properties get listed. If not all, most of the properties get listed. So if there is a listing, then there are multiple offers on one single house. So you can see that there is a lot of traction from the buyer side and they are willing to pay and they are ready to buy the houses. So it doesn't seem to be that COVID has impacted much in the housing market. Now coming to the third part, which is about down payment and mortgage. I'll start with down payment. So in Canada, the minimum requirement is to have at least 5% of the purchase price as down payment. It is different from many other countries. Like in India, you would typically have to pay 25%, but in Canada, it is 5%. Canadian government, Canadian lenders, they encourage people to buy a house to get into home ownership. That is why they have kept this percentage to be a very low amount of down payment. But considering $950,000 of house value, even 5% comes out to be a bigger figure. And this 5% is not actually the exact 5%. There's a catch in it. I will explain that catch in the fourth part where I'm going to discuss about mortgage insurance because they both are related. It's going to be much more relevant to go there in the fourth part and discuss about why that 5% is not actually 5%. The other very interesting part you need to know about when you're discussing things around down payment is that how much money you should typically have when you think about buying a house. So it's not just that you have to have that 5% down payment or whatever that amount is that we are going to discuss in fourth part, but you need to have some more money. And that money, what it is going to be, I will again discuss that part as well in the fourth part. So keep watching. Now talking about mortgage. So mortgage is a big concept. There are so many variables which are covered in mortgage. Probably I'll make entire video on that mortgage concept. But what I can say to give you a little sense what kind of rate of interest are there in Canadian market when you talk about mortgage. So I will give one example where 5-year fixed term mortgage is available at 1.8%, probably 1.75% at this point. So imagine if you are in a country like India where you pay probably 8% for your home loan. In Canada, you can have home loan at 1.75%. Of course, that's the best case scenario. But typically, you should get between 2.5%. It's all dependent on multiple factors. So there's nothing to quote here. This is a typical range where people are getting their home loans right now. So there's a lot of opportunity for people who already have a home loan in Canada and now they want to refinance that loan. So that is one part, and the other part is that somebody who's looking to buy their first house, then this is a good rate to have that and lock it for 5 years, and this is the lowest interest rate at least in last 15 years for Canada. Now coming to the fourth and the last part, and it is about mortgage insurance. So most of you must be thinking, what is mortgage insurance? Many of you must have never heard about it before. So let me tell you what is mortgage insurance. So in Canada there is a concept that if your down payment is less than 20% of the purchase price, or your loan to value is more than 80% of the purchase price, then you will have to have a mortgage insurance. So that is a mandatory requirement if your loan is above 80%. So you will have to have a mortgage insurance. What it does, it gives additional comfort to the lender that in case the buyer or the borrower is not able to pay to the bank at a later date, then they are insured and the agency which is insuring them is going to pay on behalf of the borrower. So this is like additional credit risk coverage for the lender. On the other side, the insurer is going to charge some premium on that. So that is one cost which is again involved when you think about buying a house. So this is what I said when I'm going to come to the fourth part. There's going to be additional thing which I'm going to discuss. So that 5% point that we left in third part, that 5%, when I say 5%, so it is related to mortgage insurance because the mortgage insurance products available in the market right now, there are three major agencies which provide these insurance services. Based on their products as they stand right now, the house value cannot be beyond $1 million. If your house value is beyond $1 million, then you can't have mortgage insurance because those companies don't sell the product where they cover houses having value beyond $1 million. So let's say if your house is beyond $1 million, you will have to pay at least 20% as down payment because you cannot get mortgage insurance. And if you cannot get mortgage insurance, you're not going to get loan from the bank. Second thing, where 5% doesn't remain 5%. Their term says that if your house value is up to $500,000, you will have to pay 5%. But if your house value is above $500,000 but less than $1 million, then you will have to pay 5% on the first 500,000 and then 10% on the remaining amount. So let's say you have a $900,000 house that you are going to buy. So you will have to pay 25,000 on first 500,000 and 40,000 on remaining 400,000. That is 10% of 4%, 400,000. So the overall amount comes at around 65,000. It's not that it's 5%, it's more than 5%. And that is why you need to save more money to be able to pay that down payment amount. So when you do your calculation, don't think that you just simply have to save 5% of 900,000. You will have to have more to make your down payment. Now, coming to the additional cost that you will have to have at the time of buying the house. So that cost is, one is about mortgage insurance premium. So if your down payment is close to 5%, based on this calculation that I shared, 5% or 6%, whatever it comes out to be, if your down payment is close to that, then the mortgage premium for CMHC is one of those agencies which insure your mortgage. You will have to pay 4% of the house value, the purchase price, as mortgage premium. So imagine for a $900,000 house, you will have to pay $36,000 as mortgage insurance premium. So that $36,000 plus you will have to pay tax on that $36,000. That is the additional money you should have. So there are two options. One is that if you have that $36,000 and you want to pay it upfront, you pay it. But if you don't have it, then that money is going to get added to your mortgage amount and then it is going to get amortized like your loan amount. But the tax on that mortgage insurance premium, you will still have to pay that tax. So that is one thing for sure you will have to pay at the time of buying the house or buying the insurance. Why do you need more money? So then more money is needed to cover the cost of purchasing the house as well. It ranges between 1.5% to 3.5% depending on multiple factors. But you will have to have, let's say, even if you pay 2%, so 900,000, 2%, you will have to spend $80,000 more. So $65,000 plus that tax amount plus 18,000. So to buy $900,000 house, you will have to have close to $100,000 in your pocket before you decide you want to buy a house. When you think you are ready, just make those calculations and see that you have that amount in your bank sitting already, or you are going to be there by way of planning that, okay, in 6 months I'll be able to save that much money so that I can buy that house of this particular range with this kind of rate of interest, and this is based on this mortgage insurance premium that I'll have to pay. So if you have liked the video, just hit the like button. If you have not subscribed to this channel, hit subscribe button so that I can share much more details about Canada and the Canadian market. If you think this is something which is going to be interest of somebody else, then share the video with them. Thank you so much for watching. See you next time.